How's it going, folks? Welcome to the first video of my channel. And today I'm going to be talking about a stock that I really like, sort of a stock spotlight video. I guess that's what I'm going to call it. And this stock is ticker ZIM, or ZIM Integrated Shipping Services. And it is a shipping company based in Haifa, Israel. And so they do ocean. They own a fleet of ocean-going vessels, 110 of them. They do trans-Pacific routes as well as Mediterranean routes. They can carry all sorts of different types of cargo: dry, reefer, project, out of gauge. They can carry cars, dangerous cargo services. They can even do some inland transport services, and they also have their own reefer cargo tracking service called ZIM Monitor, or ZIM Monitor. Yeah, so it has 70 weekly lines, and alongside those 108 container vessels, it has 8 vehicle transport vessels. So it's a pretty sizable shipping company. And you might ask yourself, what's the deal with the profits here? Why is it that that it's up so much? Well, one of the reasons is what you're seeing right here. And if you live in the coast of California, you might have spotted actually a few of these container ships way off the coast waiting to get into port. So Long Beach in particular, but this phenomenon carried through for a lot of different ports, particularly in the year 2020, but it's still an issue now, where there's supply chain backups. And so, ironically enough, ZIM actually profits from supply chain backups. The reason being is that when they, like this ship here, are essentially waiting outside of the port for being able to get in and unload all the cargo, they just sit still. They can actually turn off their engines, saving them fuel, and they actually get to charge a holding fee for the goods. So they actually so they have their engines off, and they're getting paid based off of whatever increment of time for holding all these goods. Which is, almost highway robbery. And this has caused their quarterly earnings just to jump and jump and jump. And guys, the fact that this is a stock that's a company that's doing quite well and stands to profit and continue to profit from the current situation with the supply chain, there's a lot more to this stock that's amazing. For one thing, its valuation is, so low. So low. Its P/E ratio is only 2.02, which is, is really hard territory to find these days. Even a lot of stocks that have plummeted on recent news, plummeted within the last couple months. Take Netflix, for example. It plummeted. And they still have a P/E ratio of 30. And that's not even really that bad when you actually look at a lot of other stocks. So, a P/E of 2, that would have been good in the 1960s, when valuations weren't as sky high and ridiculous as they are now. So, the whole market's overvalued. They always say, though, the U.S. equities are overvalued. They are. They say international equities are overvalued. They are. Most equities, in general, when it comes to the stock market, are overvalued. This, however, is not. It is undervalued. Has only a market cap of, almost $9.5 billion, and yet it pumped out a revenue of almost profit of almost $5 billion in 2021 and a revenue of almost 11. So, it's actually made more in revenue last year than its entire market cap, which is really insane because the idea behind this is you're also factoring in future profits. So what I think I see here is, an opportunity. It's an inefficiency with how the market prices something. Obviously, it's raising up to equilibrium level, but we're not even there yet. According to this little automatic, calculation bot, it has a upside of 45% estimated return based upon being undervalued. And so another kicker, if you needed anything more, is our dividend yield, which is actually was just recently increased, which is not something that I thought was going to happen. It did stand at $10 a share for dividend yield, which was plenty good. Plenty good. Now they have increased it to 19.5. So $19.50 in dividends per year for every share of a stock you own. And actually, that's at the level that it actually might scare off a lot of investors, because some investors tend to avoid the overly high dividend stocks, because oftentimes the idea is that companies will be using that, or again, who are desperate to raise equity. They'll be using a high dividend essentially to coax investors into forking over their cash, and it's not actually really something that they can sustainably afford going forward. With ZIM, this is much less of an issue given how low their valuation is relative to their profits. I mean, they actually have a bit more of an ability to pay this off than other companies would. However, there is something to note. In Israel, they do charge a 25% tax on dividends. So that's something you will have to make note of. And obviously that makes a difference on how much you're yielding. So that makes the tax situation with this stock relatively complex. And that's why I'm going to recommend, if you're going to buy this stock, definitely buy it in your Roth IRA. And honestly, all of you guys should have a Roth IRA who are watching this. If you guys are just out there using Robinhood or Webull, and you have any more than like $500 or $1,000 in there, I don't know what you're doing, man. You need to get an IRA. You need to get a Roth IRA to get tax-free investment. It charges you less. For one thing, you don't have to bother filing anything related to your IRA. And you're not gonna get taxed on those dividends if you are in an IRA. I am not sure, however, if that Israeli 25% tax still goes off it if it's an IRA. That I'm not certain of, but you won't have to pay any other taxes, that's for sure, if you're in an IRA. That's definitely what I recommend for this. Any dividend stock, or honestly, with any stock, it's better to buy it in your IRA. Because, if you buy this in a regular account and it doubles again, you sell that and you'll have to pay taxes on the profits. Still profits. It'll just take a portion of the profits. But still, better to not pay taxes on it, if you ask me. If you have a way to legally do that, which is, of course, the IRA. Federal government gave us all the ability to make IRAs as a way to essentially assist us. Throw us a bone. So, based upon three things, or really four. Solid earnings and profits, number one. Number two, a strategy or a method sort of to take advantage of the current issues in the supply chain. Rather using what for most people is a hindrance to them is a source of profit. The third aspect is the low valuation in the form of this P/E and market cap. It's low. It's hard to find that. It's hard to find something with such value. And the fourth one is sky-high dividends. Folks, what's not to like?